Welcome everybody to Volatility Trading Strategies. So I'm going to continue on with this format here where I'm breaking down some of my articles and giving them to you on the YouTube channel for those of you who do prefer the video content. And what I'm going to talk about today, and this is actually something I get a lot of questions on, because it can be very frustrating for traders who are holding equity ETFs, say you're holding the SPY, for example, the S&P 500, and you look out into the market and you see that a different equity ETF is outperforming the one that you're holding. And this can be very frustrating, and it can cause people to try to bounce around between the ETFs, trying to chase that performance. And there's a very specific reason why this is happening. It's because, of course, not all equity ETFs are created equal. They have different holdings, different allocations, different structure. So that's what we're going to talk about today. We're going to talk about why there can be differences in the day-to-day performance of these equity ETFs. So make sure you subscribe to the channel if you haven't already. Let's get into the article. All right, so this is my website here, volatilitytradingstrategies.com. You can go over to the blog section. Of course, all the videos that I upload on the YouTube channel, those are all here as well. But for the articles, many of you don't come over and read these articles, so I want to convert some of these to video format for you. So we're going to come down to this one right here, article number 607. And it's talking about this subject of ETFs performing differently through different market environments. And what I'm doing is I'm comparing the S&P 500, which is the ticker symbol SPY, SPY, versus the S&P 400 mid-cap ETF. That's a ticker symbol MDY. Now we've got a chart here showing starting in July of 2006. No real significance to that date other than that's when my strategy called the tactical balance strategy started. So oftentimes when I'm comparing equity ETF performance, I do go back to July 17th, 2006. But you can see this is a 15-year chart with the SPY in blue, and then the S&P 400 mid-cap ETF MDY in red. And overall, they basically got to the same place. You can see the annualized return, 9.9 versus 9.3. The MDY in red, it did do a little bit better through the first, say, 12 or 13 years of this test. And then more recently, the S&P 500 has overtaken it and actually performed a little bit better, especially since after that little COVID crash there, the S&P has recovered much faster than the MDY did. Large cap companies have done better than the mid-size companies. But the basic reason this is happening is because the structure of the ETFs isn't quite the same. So what we're looking at here is the 10 largest holdings of the S&P 500. And these are very recognizable names: Apple, Microsoft, Amazon. Very big companies, they're always in the news. These are the companies that everybody knows: Google, Berkshire, Johnson & Johnson. And over here you can see the individual allocations within the index. So Apple alone has a 6.45% allocation. And the top 10 holdings, 27.96, basically 28% of the S&P 500 is just these 10 companies. So that's why you might often hear people joke online that the S&P 500 is really the S&P 10. It's because there's a big skew to the largest companies in the world and all of these big tech companies. But that's different than the MDY. So if we go down to the S&P 400 mid-cap ETF, you probably haven't heard of many of these companies. I mean, Monolithic Power Systems doesn't really make the news very often. Trimble, Cognex, these are pretty obscure sounding companies. And over here you can see the asset allocations. These are much smaller. Even the largest holding within the S&P 400 midcap is only 0.8%, and the top 10 holdings are only 7.17%. So the S&P 400 midcap is actually much more diverse as far as the allocation size of these holdings, whereas again, the S&P 500 is very top-heavy. Essentially, the S&P 500 is a market cap-weighted index. The larger the company, the larger the holding within the S&P. Now, just to compare that to something else, which here is called the RSP, that's the ticker symbol, for the S&P 500 equal-weighted ETF. So if we go to the holdings here, we go down and look at the top 10 holdings, look at the percent of assets over here, the largest percent asset at 0.31%. Now there's slight differences here, just based on rebalancing periods and all that stuff, but it's essentially an equal weighted index, where all the companies have a more or less equal weighting. So all the big names that you've heard of is in here, but none of them hold a dominant weighting. 2.79% of assets are the top 10 holdings. Again, comparing that to the S&P 500, of nearly 28%. That's the difference between a market cap index and an equal weighted index. So it's pretty easy to see why there might be differences in movement from day to day. If these tech companies happen to be having a very good day, then the S&P 500, the SPY, might be doing significantly better than the RSP. Those big tech names are not going to be able to move it around. And likewise for the MDY, if tech is having a really good day, for example, that's going to have far less effect here because these are all mid-cap companies with much closer weightings. So Apple, Amazon, Google, it doesn't really matter what those ones are doing because they're not even in this index. And the largest companies within this index, they're not even weighted very heavily either. So it's pretty easy to see why there could be differences. If we want to get really crazy here, we can actually check out QQQ. Now what this is essentially the NASDAQ 100. And if we go look at the holdings here, top 10, now we have a situation where 55% of the Qs are just 10 companies. And you can see the top 3 here, right there. That's essentially 1/3 of the NASDAQ ETF is just 3 companies, Apple, Microsoft, Amazon. While the Qs may sound like a diversified equity ETF, it's actually just an Apple, Amazon, Microsoft, Tesla, Facebook ETF, and then a bunch of other smaller holdings that might influence it a little bit. But 55% of this movement is going to be on these main companies. Now, more specific to the VTS community here, just for your interest's sake, what I'm showing down here, this is related to what we call the tactical balance strategy, this one here. This is a tactical rotation strategy that shifts between positions in either stocks, bonds, or gold, MDY, IEF, or GLD, depending on market conditions. So if all of the volatility metrics are stable, that's when we're going to be holding equities. If those volatility metrics are ambiguous, we can move to safety with the bonds. And if volatility is really going through the roof, we can go ahead and hold gold. But this strategy specifically is holding that MDY, the S&P 400 midcap ETF, whenever we're in stocks. So what this chart was showing is only those stock positions since the inception of the strategy. So even though I showed that recently the SPY has overtaken the MDY performance-wise over the last 15 years, with respect to that tactical strategy, the tactical balanced, the MDY still is slightly outperforming the SPY, which means the MDY is more suitable to this strategy than the SPY is. That's why we use it. It's caught up a lot in recent years, but the MDY is slightly leading. And the same would be true for that RSP, the S&P Equal Weighted Index. That is also outperforming. I show an updated chart here that I just put together. MDY only trades in blue. This is what our actual strategy is using, versus a comparison of what would happen if we were holding the SPY in red, which is the worst performer. And here's that RSP, the S&P 500 Equal Weighted Index, basically right on par with the MDY. It was a little bit worse early on, and it's recovered a little bit more recently. But you can see that within specific strategies, different ETFs will have slightly different performance. So there you go. For those of you who are holding equity ETFs in your portfolio, you are going to have to match up those ETFs based on the goals you're trying to achieve. So for example, if you do want a heavy exposure to Apple, Amazon, Google, Facebook, all those big companies, then you would be looking at the Qs. If you want to have that exposure, but maybe not in the large allocations, then maybe that RSP, the equal weighted index, would be more suitable. And if you didn't want them at all, perhaps you're holding the individual stock and you don't want those to double up, then maybe the MDY, which is the S&P 400 midcap. You'll have to choose those. Now, for me personally here at VTS, we spread out the risk by putting each individual ETF within a different tactical strategy. So as you saw, the tactical balanced, that one does use the MDY. And then for our defensive rotation strategy, we use the VIG, which is the Vanguard Dividend Appreciation ETF. And then for our VB threshold strategy, that's the one we use the SPY. Then we've got another strategy called the Breakpoint. That one uses the QQQ. So I do spread out the risk among all the strategies that way. But you can do it however you want that matches up to your goals. So thanks for watching. And that is essentially why all of these ETFs occasionally do move at different speeds. So don't get frustrated. Just remember, dive into those holdings, make sure you know what it's holding, what structure that ETF is, and you should be good to go. See you next time. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.